Really excited to be here, talk about blockchain and specifically crowd sales, a new phenomenon that's kind of been taking the world by storm. It raised about over $1 billion have been raised via this mechanism of crowdfunding for software products. So we're going to explore kind of what exactly is a crowd sale, the implications from the VC side as well as regulatory, and just go from there. So a quick introduction of each of us. Myself, I'm working on WeTrust.io, but before that I worked at Google and McKinsey. And I'm going to ask each of you to just give a very quick introduction of yourselves.
All right, my name is Herman. I'm running a venture fund called Arbor Capital. And we are focused on the technology innovation with a cross-border angle between US and China. I did my first blockchain deal 4 years ago, and very bullish about this technology.
Cool. Yep. I am Ben. I'm the Director of Engineering at BitGo. We are the wallet platform behind many of the exchanges and ATM providers and financial institutions that use blockchain today. And we do about 5 billion in transactions a month. We work on many technologies like multi-sig on both Bitcoin and Ethereum, and we've been around since 2013.
Hi, my name is Grant Fondo. I'm a partner with Goodwin Procter. It's a law firm here in Silicon Valley that's a global law firm. I'm also head of our digital currency and blockchain global group, and is currently assisting probably, 15, 20 different companies going down this crowd sale process. I'm also a former federal prosecutor here in the Northern District of California, and have been involved in a number of the regulatory cases that have developed over the last couple of years in the digital currency space.
Hi everyone, I'm Nikolas Kokkalis. I'm the co-founder of StartX. StartX is an accelerator in the founder community that is affiliated with Stanford University. We have been operating this community for the last 7 years, and we have about 1,200 entrepreneurs that went through our program, and they're part of our family of companies. They have raised about $3 billion so far collectively. They're valued about $9 billion collectively, and we have invested in them about $125 million through the Stanford StartX fund that we operate. And personally, I did my PhD at Stanford in computer engineering.
Great to have a great group of guys here. So let's just jump in. I don't know how familiar everyone here is about crowd sales and blockchain, so why don't we just give a really quick overview of what is a blockchain crowd sale and why is it so interesting?
Well, so these blockchain crowd sales, or what people call them ICOs right now, are just generally a means for an entity to raise funds, but traditionally you would raise funds in exchange for equity. In the case of ICOs, sometimes people are doing this in exchange for a token, which is represented on the blockchain. And that token may represent something that you could use in an application, or it may represent a promise of something, or fees, or it's up in the air right now. It's the interesting thing about ICOs is that because digital currency is so decentralized, it's easy to obtain, it's global. It's currently there are very few rules around it. So we're also trying to figure out, how these tokens can be used,
but I think
which one of them are useful.
So one common way people have described it is that it's kind of like a Kickstarter for software.
Yes. Absolutely.
So what do you guys think is the evolution of crowd sales? It's been going on for a few years. What have you seen happen recently, and where do you think it's going in the next years?
So I can talk a bit about what happened in the past. The origin of these crowd sales are, they're not that new. Back in maybe 2013 or 2012, even one of the first ICOs, so to speak, was Mastercoin, and then after that, Ethereum. So Ethereum itself was started by a crowd sale in which they collected Bitcoins and gave people Ethereum tokens today. So during those times, it was mainly raised for decentralized applications. Now it's very easy to do an ICO, and people are doing them for other purposes.
Yeah, and we all noticed that with the introduction of smart contracts, which is a concept that Ethereum created, these ICOs became much easier to implement and much more straightforward for the people for the investors to be able to understand the rules that are behind its currency. And what happened was quite interesting, that Ethereum's price the last few months started to increase by almost, what was that, 100 times? From $7 became $200 and almost $400 sometime, which transformed this market, this industry of ICOs from something where people who are very passionate about technology believed and for many years and have been trying to push these things forward. And because the price of Ethereum, for example, in the past was much lower, the result of an ICO looked conceptually in the equivalent of US dollars, they looked much smaller. When the Ethereum price became higher, much higher, all these ICOs translated into a much higher number of US dollars, $100 million, $150 million raised within 30 seconds of an ICO, which all of a sudden brought the lights of consumer magazines and newspapers and even taxi drivers. I was on an Uber the other day and a taxi driver asked me about ICOs and cryptocurrency. He wanted to invest in cryptocurrency because the other people are creating IRAs that will be in cryptocurrency. So that's what's brought all this light. And
great. Yeah, and I would just say what we're seeing originally when clients were coming to us to do these token sales, they were very crypto focused, meaning crypto companies or very, very sophisticated technology companies trying to do these. You're seeing over the last couple of months, what we're seeing is that more mainstream companies are doing it. Companies that you wouldn't initially think would be in the crypto world are seeing this. You're also seeing, and some of these are large, pretty established companies who have raised lots of money elsewhere or otherwise funded in a different manner. And so I think you're starting to see the evolution of this technology and this fundraising source really spread out to a variety of industries.
Okay, so it's an interesting segue, right? In the past, what I've seen, the types of companies who raise funding through this method are companies who are creating a product that are trying to disrupt the concept of a trusted third party. Right? By using the concept of a blockchain, you don't have to trust a central authority. But as Grant kind of mentioned, that is kind of evolving because, as we said before, if it's a Kickstarter for software, and as long as you're adding value, then maybe you can do a crowd sale. What do you guys think about kind of that evolution from really that crypto focus, the concept of decentralization, to maybe something a little bit more broad?
Well, I concerned discuss, from my investor's standpoint of view, and this quad sales or ICO has two immediate impact, basically on us as investors. First of all, it's eliminate the barriers for ordinary people to access deals, to eliminate barriers for most startups to access capital. And it creates immediate liquidity for those tokens. This is number one. And number two, it's also going to disrupt the capital market in the long run. And I think I'm, like what I said in the beginning, I'm more bullish on the technology of blockchain itself. I think ICO definitely has a long way to go. It's going to get mature, and many services will be probably implemented by the technologies down the road.
How about the impacts on, maybe let's dive a little bit deeper on the potential impact this has on the traditional venture capital financing process? Yeah, Grant, you mentioned some established companies are going this route. And I know some startups who haven't raised funding that are looking at this as the first option. But I'll let you guys.
Yeah, no, I would agree with that. I think venture capital used to be the mechanism essentially to raise fund as an early stage. But it's hard. You have to get an audience, you have to convince a venture capital firm that you're the top two that they're going to meet with, that quarter, and that they want to invest the money in. And there's a lot of strings attached, including giving up equity. What I think is attractive to people in this crowd sale market is that they have the ability to bypass that and go directly to the public, if you will. And what's really interesting is the ethos of these individuals who come to us and companies, that they are very much interested in having the public invest in them and purchase the tokens, I think because they think it's the best way to raise money, the most quick, most expedient, but because they believe in the democratization of investing in companies. And this should be everybody's access, not just accredited investors or high net worth connected people. And so I think that's another aspect of this industry that you're seeing. And I think it's really built in to some extent from the core of how digital currency started, then the blockchain, and now these fundraising methods.
Yeah, and a lot of founders actually come to us, and initially what drove to come to us was the promise that this is a non-dilutive way for them to raise capital, which means that they don't have to give equity stocks of their companies to investors. But very quickly they realized that by creating these cryptocurrencies, it's actually not as it's not only that, but it's that they are imposing certain very specific restrictions or through these smart contracts that they implement for the crowd sale. They're putting all these restrictions on how they can use the funds. In a traditional VC equity raise, you convince an investor that you have the right judgment and they believe in you, that you will use their money towards building a great company. And along the line of creating a company, investors understand that you will need to make a lot of tough decisions. So you need to potentially even pivot the entire company at certain points in time. And no investor expects you that you will implement exactly what you showed them in the PowerPoint slide deck. However, when people are designing these crowd sales and they impose those restrictions on how the funds can be used, in a way, these restrictions are, depending on how you crafted the smart contract, they are written in stone in a way, which means that they are going to be running their business exactly, certain parts of the business at least, the ones written in the smart contract, exactly as they designed it on day one, which is a good thing and a bad thing at the same time. It's a great thing because with this facility, they can guarantee all the people who backed them that they're going to deliver on what they promised to deliver. And at the same time, it is a little bit challenging because what if the market changes? They actually need to change the way they're doing business in the future. It will be much more difficult. So these are the things that entrepreneurs quickly come to understand after their initial impression that this is just a non-dilutive capital, so it must be great. Let's do it.
Right. So some of them come in with that opinion, and they find that these smart contracts, they need to be written prior in stone, and sometimes you can write different decision points in smart contracts and so on. However, in the end, you may not actually have to code everything up into a smart contract. You can just run a business. One other interesting thing I think that is different with these ICOs or crowd funds versus traditional investing or taking money from traditional investors is that now similar to Kickstarter, you have a group of fans that are going to come in and they're going to get invested in not just buying your product or investing in you, but they'll now become your fan base. So now you can start creating a community as part of this step as well, at the same time as you're collecting some funds.
Speaking of democratization of ownership. the
Yeah.
feel. The,
Yeah.
Yeah, something that we've seen at We Trust is there's a lot of enthusiasm for the type of product that we're building. And so every week, more and more people join our Slack channel, they follow our social media, and they are really excited to see a company building a product that is aimed at typically the unbanked. And so people are always coming up with new ideas, thinking about making introductions for us to other partners, NGOs, and so forth. And I think that is, you're kind of building a very large fan base, and that's kind of a very interesting phenomenon for these projects that raise through the crowd sale process. It is both an asset, because there's a lot of supporters, and also a liability because many people are there, they're always asking like, hey, what did you guys do this week, and what did you guys have planned for next week? And so there are a lot of expectations that are similar to a public company in some ways, but you are a very small startup with startup resources. So it poses, it's a kind of a double-edged sword. I don't know if you guys think, there's a lot of advantages of raising through this method. What do you guys think are some other drawbacks potentially? And maybe Grant can start with maybe some of the regulatory issues that are faced in this realm.
Sure. There's a lot of regulatory uncertainty. The key issue, I think, with these tokens is whether these tokens are going to be viewed as a security or not, and thus regulated by the SEC. So these tokens are, one of the things that is different and why there's a lot of argument that they are not securities is that you are not getting ownership into the company. You're getting a token much like a computer arcade used to be 10, 20 years ago, where you buy a token and you get to use the platform or use the product. And so that's part of the regulatory regime that you have to be aware of. And another aspect of it, there's a case that came out recently, it's the Monsoon case with the SEC, where you have to be also concerned about are people buying the token or you selling the token solely for the purpose of the increase in value. So people are buying it not to use on your platform, but simply because it's going to go up. And the more that people are using the token to use it on your platform, purchasing it to use it on your platform, the better from an SEC perspective. There's also other ways to get around it through unaccredited investor using, and people are structuring things to just access unaccredited investors abroad, as well as using accredited investors in the US to wall off some of those securities concerns, SEC concerns. You also have concerns about, is this potentially a commodity and regulated by another governmental entity? There's also very significant tax implications, and so that's something people always have to consider. And then also, if you are buying and selling, if you as the company are selling the tokens, I think there's some money transmitter issues, which is FinCEN regulates them. So there's a lot of regulatory issues with it. There's ways to minimize that risk, but there's still a lot of uncertainty in the industry, and that's clearly one of the biggest drawbacks, I think, is that uncertainty. But it's being dealt with, and it's a risk, but there's ways to minimize it and try to do the right thing and fit within the appropriate regulatory regime.
Yeah, I totally agree with Grant's point. I think regulation, will be there someday, somehow. It won't be missing forever. Another big concern, I think, as individual investor, actually, before I made my the deal, the first blockchain deal, I kind of opened bunch of accounts, try them on to trade. One concern definitely is security, because it's first of all, it's open, to be hacked, and second, we have seen, plenty of startups, open stores and set up another gateway. Just this wallet is just not valid anymore. So many of my fellow individual investors, they have to put their cryptos all over in different exchange, different wallets. So that means the public trust is not there yet. It's how we solve this problem.
Yeah, it certainly is very complicated if you want to. Yeah, it's still very, very user unfriendly to figure out how to store the crypto today. Mm-hmm. Any other kind of drawbacks to this crowdfunding model, aside from regulatory issues that you guys are aware of?
I can offer one from that I hear multiple times from founders. They're worried about volatility of those cryptocurrencies. Sometimes the market goes up, sometimes the market goes down. So they raised 50,000 Ethereum. Today they're worth 50 million. Tomorrow they're worth 10, and they're worried that should I convert some of that back to fiat currency, US dollars, so that I can, at the worst case scenario, be able to pay my employees' salaries? Should I not?
Right. I think it works both ways. One advantage of being liquid is you can value your tokens on the market. So, for example, and this is a rare, a smaller case, but say you're running a startup, and right now today you're offering your employees some equity, and they don't really know how to evaluate that. You're offering 1% of what? But if you offer them some tokens, they actually know what is the value of those tokens, and you can promise it to them eventually.
That's a very good point.
Yeah, and I think there's a lot of innovation now. Cryptocurrencies are very volatile. There's also the concept of stable coins or tokens that are pegged to some other asset in the real world, whether it's a commodity or a fiat currency. So there might be ways to tackle that problem of volatility in the future.
Grant, are these considered regulated, like bad in terms of SEC's perspective?
The government's definitely looking at these. I've spoken with people at the SEC, have been and other regulators. They're clearly looking at these sales. One of the number one things, and this is what we advise our clients, and it seems obvious, but is tell the truth. And so as you're doing these, Nikolas mentioned that oftentimes these token sales say this is what we're going to do with the money. And so it's very important that you keep your community happy so that they don't get upset, report you to regulators, etc. Because what the government is most focused on is consumers. They don't want people hurt by these token sales. And we talked about the stability token. So if people suddenly start losing tens of millions of dollars on your token because you either did something wrong, you lied, etc., that's really going to bring scrutiny, not only from the regulators, but from people potentially suing you. And so that's both the downside and the value of the stable token. And so it's like any business, there's certain risk, and you really want to be careful about minimizing the risk that you can control.
Great. Thanks, everyone, for your comments. Let's open it up to questions from the audience.